Okay, what's going on, guys? Jay here, smarthelping.com. I've got a cool new model. It's a manufacturing made to order or built to order business model. And this is the probably one of the most impressive financial models I've ever done. We're going to include accounts payable, accounts receivable, very flexible logic for um, when you're when you're collecting payments from customers relative to when they ordered, the percentage they collect at different months in that life cycle, as well as payables for raw materials. All the accounting logic here, you can also do accrual or cash basis. You can see here balance sheet's uh, very robust with, you've got unearned revenue, accounts payable, debt. You've got all these fixed, your assets, receivables, inventory, cash, all this stuff that's related to manufacturing. It's very difficult to code all this correctly and make it work with all the different assumptions. And so let's get into it. And note, like the video, subscribe, links in the description box below to purchase this template. And here we go. Um, all right, so each input, I'll go through and all the yellow input tabs. Note you're going to only adjust these shaded cells with blue text, and then all your summary reports will automatically update as you're updating the assumptions. So here you can just put company name, whatever that is, launch year. Note if you do change the launch year, make sure all the drop downs and date functions and all the yellow tabs make sense with this launch year. Like you shouldn't have a date that happens before 2024 if 2024 is your launch year. Uh, Here we can determine if we want to how long we're going to run this financial model for, up to 10 years. Here we're just doing a full 10. You can include if you want the terminal value or not. If yes, it's going to be based on this percentage, whatever you do input for the trailing 12-month sales multiple. Um, you could change that, what have you, or you could not display it, and that's fine. It's mainly for discounted cash flow analysis. Cash sources. So here you're going to have debt and equity. Debt is just an input, and you'll come back to this more towards the end once you've figured out all the other assumptions in your burn and initial, equity requirements. You can figure out of that how much you want to finance with debt. The rest is going to come from inside or outside equity, and that'll be defined on the cap table here, which we'll go through. We've got taxes, just regular income tax, long-term capital gains. And then again, you can choose accrual or cash basis. Cash basis just says you're not going to have any payables, inventory, or receivables. You're just going to, when you collect cash from customers, that's when revenue is recognized. When you pay for your raw materials, whenever you do pay, that's when that's recognized. There's no, accrual accounts. There's no unearned revenues, anything like that. Accrual has everything, payables, receivables, unearned revenue, inventory, all of that stuff. So you can pick here and it automatically shifts all the logic and it has been checked for accuracy intensely. So we'll just show accrual method to start. And then you've got your checks here on the front just to make sure everything is lining up. These should always be 0. All right, unit cost. The first main tab, you're going to define each of the different types of units or categories of units that you're manufacturing. Up to 10, you can put in your manual unit or your material cost per unit here. So this is just like if I was selling clocks, if I was manufacturing clocks, I could put each of the individual costs for a given clock that I need to purchase to make the clock. So all the cost per unit you put in here, up to 25 different items can make up that cost. And that's going to drive your inventory and direct materials, cost of goods sold. They directly scale with the count of units sold. So you can fill that out here. These just the total cost per unit will come up here. You can also determine if you're paying for those things and you have payment terms. For example, maybe at the purchase month you pay for 50%. Maybe a month later you pay another 25. Month after that you pay 25. Or whatever your payment plan is. If it's all up front, then in month 1 you just put 100% and zero these out like this. And that would just mean you're paying for all this up front. If it was 50-50 when you order it, you pay 50, and then maybe, after 2 months you pay the other 50 or whatever, or 3 months. This is just very flexible for you to determine when you're paying for your cost of materials. And that will affect accounts payable in here. This row will be your payables, and it also affects inventory when the full amount's ordered. That increases inventory, and then when the unit is actually shipped, that's when this decreases. And that's a big thing with this, with accounting and manufacturing for made-to-order models, is you can't recognize revenue until you ship the product to the customer, and you can't recognize your cost of goods sold until it is shipped to the customer if you're doing accrual. Okay, so that's an important thing to understand as we go through here. Next tab, sales, pretty simple. You can put the order of each type you think you're going to have each month over 120 months. So manually entering this, it could be high volume, low volume, doesn't matter. All the logic applies arbitrarily. So you just put how many of each type of units are you selling or getting orders for each month. These are orders. This is when you're recognizing that revenue and expenses, when it is shipped. Okay, so months since order, this is when you're collecting money from your customers relative to when the order happens. So technically, let's say they order the first month you collect 50%, and then maybe when you ship it, you collect the rest. That's a common scenario. The other one that usually happens is, let's say when you ship it, a customer maybe pays 50%, and then maybe in month 8, they pay the other 50%. In this case, you created a receivable. In the case where they pay up front and you haven't shipped yet, you're creating a liability, which is unearned revenue. And this model will dynamically, based on the order, the month the unit ships, and when you're collecting this, it will either show up on the balance sheet as a receivable or unearned revenue, and then it flows through to the cash flow appropriately. And you can see offsets here happening, so we know exactly what is actually happening as far as cash flow each period. So this is awesome. This logic here is really, really cool. I think it's very useful for planning, to get the cash flow right, to get the proper items on the balance sheet, and allow you to configure your scenario. I'll leave it as default. We'll just do, let's do 3. Let's say they pay half, then 25%, and then maybe 1/10. Let's say it's a longer sales cycle. That's when it's shipped, and they can pay the rest. These percentages should always equal 100%, unless I guess you could account for not collecting everything. Maybe 99% or 97. If you have, you think some customers won't pay, you don't have to do 100% in that case. Here you're just defining the sales price of each unit that you're selling over time, so you can adjust it, and you can also adjust it by type. Here I did other ancillary income. If you have other income sources, you can just put a monthly amount here of that, annual increase in that revenue, and start month. So this is not granular at all, but some people will have other revenue sources besides just selling their product, and you can account for that here just generally. Then there's just some summaries here for total sales by month, total monthly sales. And again, that really doesn't flow anywhere because we're not recognizing, if we're on accrual, we're not recognizing sales until it's shipped. If we're on cash basis, we're just recognizing it when we collect the cash. So this is actually not going to flow anywhere, but it's just kind of a summary of what's happening each month for orders. Sales matrix here, and I've labeled each section. You can see how all the dynamic logic is working so that everything I just went over actually can happen and works dynamically. And I've labeled it so you can go through the formulas, you can see how everything's flowing, and it's labeled to make that a bit easier. All right, fixed expenses. So here, the top section is strictly for production overhead. This means utilities, plant rent, property taxes, insurance, plant manager, any overheads that are directly related to the manufacturing plant and process. Even rent for inventory space. You could also put direct labor here, and you would just put the fully loaded monthly cost of each cost item over time and the start month of each as well. And if it's an employee type that has payroll tax and benefits, you want to include the fully loaded cost because that's not going to come up anywhere else for this part. This will also flow through to the indirect overhead cost per unit. And as we go down, these are fixed costs not directly related to manufacturing, but obviously it's a business, they all are needed, but here's like the CEO, maybe a business analyst, manager, office manager, things like office rent, maybe legal accounting, those types of things. And again, you could define the monthly cost in each of the 10 years in the start month of all of these. These are just going to be regular OPEX. Payroll tax and benefits will apply to this section. If you put a 1 next to it, that means it's a employee type, and it will add this 35% tax, and that will flow through to the financial statements accordingly. Units wasted, if this is essentially going to act as an expense that offsets revenue, just based on if you put 5% here, essentially it means you're losing 5% of what you actually could sell. Raw materials. So here, remember we talked about when you're paying for your raw materials based on this, but here you can define how much raw materials are you buying at a time based on your expected demand. So in that case, you can see the materials tab here. We put 3, so we're buying 3 months worth of materials in month 1. We're paying for that based on the schedule we defined on our unit cost here. So we're paying for that over this schedule, but it's going to increase inventory by whatever that amount is. And then cash will go down and accounts payable will go up based on the difference of what you paid versus what you actually purchased and received. So that's that. Equipment, we go here. You've got the month in service of each equipment that you're buying. So these would be like things you're putting into your plant to build stuff. You put the cost per unit, total count, and that's going to go through to depreciation. And that will count for depreciation cost per unit type. So that's broken down and based on the percentage you define for each equipment here that's used for like type 1, 2, 3 through 10. So if it's all even, you would just put 10% for all types. If you're producing 10 different types of things or categories of things and they all evenly use each machine, you would just put 10% for all of them. If, for this machine, you're only using type 1, 2, and 3 evenly, and then maybe for like here on this machine, you're only using it for type 4 for half and the other half for type 5. You can see how that works here. So this is a unique schedule just to try to allocate the depreciation correctly. This good or bad here is just making sure you don't start producing a given category and assigning a percentage before you have a month in service. So for example, if this was like March, this means you bought this machine in March, but if you're starting it in January, that doesn't make sense. Like you can't have start producing this in January, and assign it a percentage, but this equipment actually hasn't been purchased yet. So in that case, you would see an error here. And I would say, okay, well, let me adjust this. This is actually March. This is March for this unit type. So that checks each percentage, just making sure you don't have a percentage in there that would not be logical. Now this will go through, and I'll show you the depreciation matrix this affects. This goes through and affects this here. So you can see the depreciation for each item. And then here, this assigns that depreciation cost to each category based on those percentages we just went through. This is just the depreciable value of an asset. This is just a kind of an ancillary summary. Okay, so there's equipment. Now we go to startup costs. These would be other deductible expenses or maybe a reserve or anything that's going to hit right at the first month of operations that you have not accounted for anywhere else. Cap table here, I just put whatever share units, just could be arbitrary. Usually it's going to be 100% common. And then this filler will tell you how much equity is needed based on this requirement and what else has been collected from any other outside investors and any inside investors. So, and you also want to make sure this percentage, these total percentage of common stock plus this should only equal 100%. So don't put 100% here and like 20% here. It'd be, of the total equity, what percentage is going to each of these, what percentage is going to each of these, and that should never go over 100%. If you just want to zero it out and just say, well, there's just one investor group or whatever, and you don't want to separate it, you could just zero this out, put 100 here, and this automatically there's a formula here that just fills in the total equity required based on this number. And this is just taking your minimum cash based on all the burn, any startup costs. This is saying how much cash you need just to make sure you're at never go below zero. You can see the balance sheet will solve for that. So if we look at the cash balance, this will hit zero at one point, but it will never go lower. That's what the model solves. And where's our zero? There it is. So month 35, we actually hit zero, and then we start making, going up from there. So that's what this number is, investors, and then there's just a IRR analysis 10-year for each individual row, depending on what you filled out, and an aggregate in the IRR, inside versus outsiders, investors. Okay, let me put this back. We'll do 2080. Let's say the founders are coming up with this amount here. Okay, building, this is just a separate area to account for if you're going to buy or construct the building, what's the total cost, useful life, and then if we are including exit, what's the sales proceeds, and that will all be counted in your terminal value calculation. Note, if we put no here, then nothing comes in. If we put yes, all those numbers I just went over will come in here based on percentage of revenues as well as the building value at exit. Okay, what else do we have? Now, if you're renting the building, obviously you wouldn't have a building cost or any proceeds. It'd just be rent, which you would define on the fixed expenses for property plant rent in one of these rows. And then here's the debt schedule. So this is going to come from the main global control tab, which you'll go here and be like, okay, we need 6.9 million. If this was zero, you say, well, how much of this do I want to put up in debt? Maybe $1 million. So you get a loan that reduces your equity requirement, but you also have debt payments based on that as well. And then you can define the debt terms here on this tab. Just make sure the first payment date is not before your launch year. If you do end up adjusting the launch year, then this should not be before that launch year. And then you could do the term, the interest rate, the payments per year. Okay, then we have our statement. So income statement, you've got your unit sales, your ancillary income, and you can see how this is 88888. If we were to go cash basis, well, still the same because we're selling everything for the same amount. Let's see. Let me go accrual, sales, monthly units shipped at 10. Oh, wait, I'm in year 9 or year 10. That's why it didn't make sense. Okay, there we go. So accrual, you can see here is your unit sales getting recognized up here as they're shipped. This is just your other ancillary income. Then you've got depreciation happening in your cost of goods manufactured. Material costs, again, being recognized in the month of the unit shipped. Depreciation from facilities, and then other indirect overhead, and your total cost of goods manufactured, gross profit. Now this gross profit or this loss here is just because you're not recognizing that revenue again until it's shipped. And if it's a long 9-month cycle, then your initial period of production, you're not going to have any revenue recognized. You might have cash though. If you collect some cash up front, like here we're saying we're collecting this cash up front, that will help offset some of those production costs. So you don't need as much equity invested to get things off the ground. But again, it'll just be based on your assumptions you enter, and all these things will update. We have your regular OPEX, EBITDA. Now again, this is not including depreciation or amortization or interest or taxes, just essentially your operations, cash flow items only. And that eventually gets to a positive amount based on our assumptions. You've got interest expense, all the depreciation expenses for all the different items. And then here, extraordinary from sale, this will only populate at exit. If you're including a terminal value, and taxes for that month, whatever that month is, will pop in as well. Then you've got taxable income and net income per month. So that's on a monthly basis. Annual, same deal, but on annual, there's checks here to make sure it equals the monthly. You've got your balance sheet, monthly and annual. All this ties in together, the income statement, balance sheet, cash flow statement. So your cash, inventory, accounts receivable. Here we don't have any receivables because we're collecting all the cash up to when the unit ships. We're not collecting any cash after, so we're never owed any money by customers technically. Now, if they didn't pay until after it ships, then you start to have receivables. Fixed assets, all the equipment, capital assets, accumulated depreciation, total assets, payables, unearned revenue. This is a liability. This unearned revenue is saying this is how much cash you've collected, but you haven't provided the product or unit to the customer yet. So that would be like all the cash collected up until month 10. So this 75% in month 1 and 6. Now having these dynamic is a really awesome. I love this model. So good. Long-term debt, equity, retained earnings, and then liabilities plus owner's equity always equal assets. And there's your check. Annual balance sheet, same deal, but on an annual basis. Cash flow statements. Now here you see what is hitting. So you've got earned revenue. You got your operating expenses, not including depreciation. You've got your actual payments made for materials, when those payments are going out. You've got your interest, taxes, and then you've got reducing the increase of AR. So this is when this would be if you were collecting cash after you ship, then you would be recognizing that revenue when you ship it, but if it's a receivable and you're still owed, you got to reduce it back out, and then you actually add back in when you're getting customer payments here. And that works for unearned revenue as well, but unearned revenue is just going to affect not receivables, but the unearned revenue account, and then the cash comes in here. Now, cash basis, none of that is, if you do cash here, you can see on the cash flow statement, there is no receivables or this. It's just this revenue. Earned revenue is actually when it is being collected. These expenses are happening, when they're paid for, materials when they're paid for. So that's the difference right there between cash and accrual on this model. Then we've got investing activities, just some CapEx, sale business, sale depreciable assets, borrowing of long-term debt, principal payments, sale of stock. And no, this sale depreciable assets is just going to be essentially when you define your terminal value, like the percentage of sales, it's going to include selling all your equipment. So you want to put of that terminal value, what percentage is extraordinary income versus equipment. Here we're saying only 5% is going to the CapEx equipment items, and that would flow to here based on any remaining depreciable value, and then you get a gain or loss, which is defined, which will hit on the income statement in this one here, this row. And then the rest of the income is hitting here. Note most of this is just the sale of the building. If we didn't have a building in this case, if we just zeroed this out, then you can see this is a much lower, 490,000. I'll undo that, and I'll keep all these assumptions in here. I think on this model, it's kind of important to not start it blank because there's so much going on. You kind of need to see how the numbers flow with it already filled out a little bit, and then you can obviously go in and put all your own numbers in here. Actually, I will, so in the purchase, I will include a blank version as well as a version that has all these numbers in it. So you can have, that'll make it a little bit easier. Cash flow statement annual, distributions. Here's your discounted cash flow analysis. You plug in discounted cash flow here. You can see the project level cash in and out over time. What's your IRR? What's your net present value? Then you can see the owner and investor summaries themselves and their discounted cash flows and net present values. This is again based on the cap table assumptions and inputs put there. And you've also got a summary and a check to make sure this matches the other monthly and annual detail. Executive summary, you probably spend a bit of time here as well. This is going to be where you see high-level items, so your revenue items, your cost of manufactured goods, your overheads, your EBITDA, EBIT. So I included the EBIT so we can see what happens after we include the depreciation expense back in, and this is just earnings before interest and taxes. Then you've got annual EBIT per unit produced. This is a cool KPI. Debt service, and you've got all these other cash flow items, taxes, debt funding, CapEx, exit value, payment for raw materials. And then these three are how you're showing AR going up and down with unearned revenue and payments collected from customers. We've also got the IRR of each in a summary here for the investor, owner, and project level. And again, I check to make sure these numbers in aggregate match all the other summaries. Visuals, like the visuals here, pretty clean, simple, showing you just on an annual basis all the key figures: annual revenue, gross profit, margins, earnings before interest and taxes, cost per unit sold, average, cash flow, cumulative cash flow, accounts receivable, inventory value, payables, unearned revenue, and retained earnings over time. Now, this monthly detail here is where everything's kind of coming together. The one tricky thing is if you're doing cash basis, it's not going to, when this recognized revenue is not going to sum up this, it's actually just going to it's going to pull from the sales matrix down here because I had to do some more complex stuff to figure out what's actually getting, where is it? Here, wait, under revenue. We're actually pulling, we're pulling the total recognized revenue, which would be the cash receipts. In this case, that would be, where are they? Here, cash received at or after shipment, 619, and unearned revenue. So these are actually when you're receiving cash from customers. So those two rows will drive this total if you put cash basis, and it will not, this won't be relevant anything above it because this is just based on accrual. But if you do cash basis, the right number will come into the subtotal. It just won't match what's above it, which is fine. It'll get you the right numbers at a high level. Okay, so if we go through this just in general, you got your orders by type, when you're actually shipping these orders over time, the month it ships. Here's the logic to figure out when we actually can recognize the revenue. Then here's revenue recognition, cost of materials ordered. So here I'm showing you the total cost at the order point, not what you're paying. This is when you're actually paying for it here, and depending on how much you're ordering at once, it'll be some function of these numbers here. for your inventory and cash flows for that. Indirect overhead per unit. So here I just did a high level. I'm just assuming it's average of all the units gets the equal amount of the indirect overhead. So it's taking this total of all these indirect overhead items like property, plant, rent, utilities, any direct or indirect costs related to the manufacturing process, like the manufacturing plant itself. All that stuff is going to 234. It's just dividing by each unit individually. So that's coming in here. You've also got equipment and depreciation. This is coming from those matrix I showed with the depreciation tab all the way at the far right. So how much of the equipment's getting depreciation costs getting allocated to each unit. Also, same thing for the property plant or the plant and building. This is just taking that total depreciation divided by 10 for each one. This total depreciation here will always equal, if you look at the income statement, the total depreciation. So you see this is 13,801. These two, depreciation and depreciation for facility plant, is 13,801. Then it's 17,967 here. You can see 17,967 total depreciation. So it's just aggregating these between what was depreciation for equipment versus plant. And again, it's not double counted. That's why we're making sure we do the correct formulas for EBITDA and taxable income. So there's that. Total cost of goods manufactured, gross profit, average cost per unit sold. So when you're selling the units, this is just taking the total cost that happened against when they were sold. Now, it's debatable if you want to apply this number to the sold or ordered versus when it was shipped. If you wanted to do shipped, you would just divide by 31 instead of by 17 here. This number doesn't flow anywhere. It's just a kind of an informative number. It would make sense a little bit more when you're at a stabilization. But all it's doing is taking all your costs, indirect costs, against the total units. Here's your fixed costs, payroll taxes hitting here, that waste item we talked about. Then you've got EBITDA, debt service, and all these other cash flow items. And these also are going to be the more complicated cash flow items for AR and unearned revenue that will flow up to here as well. All right, well, we're getting to the end here. This is the annual detail, same deal as the monthly. And I did put in groups so you can group this and just see high level items so it's a little bit easier to review if you don't want to see the detail. And same with the monthly, has the same functionality. You could group these if you wanted. Let's see, we went over all this. Yep, I guess that's everything. So if you are doing build to order manufacturing, or honestly any kind of manufacturing, you could always say this ships in the same month it's manufactured. If it's instantly, you could put a 1 here, or if it's 2 or whatever. But this is really any manufacturing business. It could be useful for. I think it's the best. I've done a couple different manufacturing models in the past. This is the most robust and dynamic. I think adding the receivables, the cash flows from that, this logic with order versus shipment, and all of those assumptions. I really like that where this is at. This is going to be very useful for a lot of people. All right, like the video, subscribe. You can buy the template in the link below, and I will see you guys on the next one.